The broadcast is now starting. All attendees are in listen-only mode.
Welcome everyone to Nova 401k Associates webinar, Common 401k Plan Errors with Steve Vest. Before we get started, I would like to point out the panel on the top right-hand corner of your screen. You will see a drop-down section for questions. This is where you will enter in any questions you may have for Steve, and Steve will answer as many questions as time permits. Please be sure to make your questions as descriptive as possible. If time runs out and you still have questions, please send them to our email address, webinars@nova401k.com. Right below questions, you will see the handouts dropdown. Here you will be able to download today's material. If you are with us today to earn continued education credits, please be sure to stay until the end of the webinar to fill out the survey. This will allow us to track your time and participation. Certificates will be sent out within a week for those who meet the time requirements. To view any webinars you may have missed and the recording of this session, you can follow us on our YouTube channel, which is Nova 401k Associates, or you can visit our website, which is www.nova401k.com/webinars. Thank you for joining us today. I would now like to introduce Nova's Vice President and shareholder, Steve Vest.
All right, good afternoon, everyone, and welcome to the webinar. As you have questions, feel free, as Yvette indicated, to type them into the section there. Yvette, we can stop if we're on a particular slide. If somebody has a question on that, we can handle that right then. And if some build up, we can also have some time at the end of the webinar. So again, our webinar, quick disclaimer. Again, this is just general information and not legal advice or tax advice. And if you need that kind of advice, just make sure you consult a qualified professional for that. Again, for the CPA credit, our provider number is 009820. You need to have registered individually, be present for the whole webinar, and then return the evaluation form and survey as Yvette said at the end, and you'll receive your certification within about a week. So some of the objectives here is to really identify who is a fiduciary and who is not in the plan. A lot of individuals who are actually administrators of their 401k plans don't realize that they're a fiduciary. We also want to identify a lot of the common problems that not only we see in our practice and experience, but also that the IRS has identified. They've got a list of common errors and what the corrections are for those errors that they post on the IRS website each year. Again, how do we avoid these errors? That's part of the important objective here. And then just about any error can be corrected. So we'll talk about what is the correction for some of the more common errors that we have. Also, just to start, I like to throw this chart up to show the arrangement that we have with you and your companies. Generally, we call this an unbundled arrangement where we have a variety of service providers that work as a team to provide the overall compliance services for your 401k plan. First, you're going to have your investment provider, whether that's John Hancock or Voya or Empower. We work with a variety of partners on the investment side that provide the mutual fund platforms, the 1-800 access, the internet access, and a lot of educational material for your 401k plan. Then we are the TPA, that stands for a third-party administration firm. We produce all of the government compliance requirements, the compliance testing, your legal plan document. We keep that up to date. In some cases, we're involved with loan and distribution, not approval, but review, initial review, and then you go and approve it. And then finally, since neither we as a TPA or your investment provider can provide specific investment advice, you'll typically have an investment advisor on your case who can help with annual enrollment meetings. If your participants need help determining what investments might be suitable for them, that individual can then help out with rendering advice on those. topics. So why is this important in terms of what we're going to talk about today? Operational failures, as we find in our practice, are much more common than investment-related losses. If you go online, a lot of the commentary is about, potential lawsuits or liability regarding the investments in the plan and whether they're suitable. But in reality, what we find is, not operating your plan in accordance to the IRS rules is much more common and usually, results in much higher fees, especially at this mid to small plan level that uh, size plans that we deal with. And also, the fiduciaries bear personal responsibility for fiduciary breaches and losses. Not every error that we're going to talk about today is necessarily a fiduciary breach. Okay, it's a mistake, but it's not one that necessarily the fiduciaries are going to bear their personal liability for. We'll try to identify if there's a difference there. So this is just a quick chart just to show that the IRS and the Department of Labor do monitor and collect quite a few fees for various problems, and we have over 6,000 clients now, so many of them will get letters from the IRS for audits, just random audits, and both agencies are actively monitoring the 401k plans and do have recoveries each year. Just to show you, the penalties for noncompliance of various issues have gone up as of a couple of years ago by a substantial amount. And we actually do see penalty notices for, let's say, missed 5500s, which is your annual filing for your 401k plan. It's not uncommon to see $30,000, $40,000 penalty notices sent to clients who have missed a prior filing. There are ways to, again, fix that and deal with the IRS on those penalties, but as you can see, they're quite substantial. Now, just about any error in a 401k plan can be corrected. The IRS has an employee plans compliance resolution system, which has three components. Depending on the type of error, you can either self-correct the error, meaning you don't have a formal filing with the Internal Revenue Service to fix it. You can just use their examples in this program on how to fix it and do it yourself without doing a formal filing. Certain errors cannot be fixed without a formal filing, and that filing would be done under the voluntary compliance program section of this program. And then finally, if you simply get caught on a mistake because of a random audit, so you haven't fixed it and the IRS just catches you outright, you're now negotiating fees and penalties under their audit cap program, and those penalties can be substantially higher than the first two situations. So if you're filing a VCP filing to fix any kind of compliance issue, the fee, the user fee to the IRS, just depends on the market value of your plan at the current date. So anything that's 0 to 500,000, you have to pay the IRS a $1,500 fee, then 3,000 for 500,000 to 10 million, and then anything over that is 3,500. So getting into fiduciaries, all right, there are three types, and we're not going to deal with the first two. The 321 and 338 are investment-related fiduciaries. We really want to focus in today on what we call the 316 fiduciary. Now, fiduciaries is any individual or entity who exercises any discretionary control over the plan administration, exercises any control over the plan assets, or renders investment advice to a plan for a fee. Okay, that's the general definition of a fiduciary. So examples of those types of individuals would be your investment advisors, for example, that we just mentioned earlier, the trustees of the plan. These are typically named individuals in your legal plan documents who have the authority to delegate many of the functions to other people in the company, but at the end of the day, they are the bosses of the plan, right? The investment managers, again, who manage the actual mutual funds, at either John Hancock or Empower, those types of firms, um, are also fiduciaries. If you have an administrative committee that meets and makes decisions on the 401k plan, all the members of that committee are going to be fiduciaries. The plan administrators, who we'll get into, and like who is the plan administrator, uh, and any person at your company who hires and fires any of the above. So the owners of your company, even if they're not the trustee, are fiduciary. Okay. So the 316 fiduciary is defined as the plan administrator of the plan. And the person could be named in the document, but typically is not. And if they're not, then the 316 fiduciary is the plan sponsor, the company that's sponsoring the plan, your company. All right. And specifically the individuals who are responsible for managing the daily operations of the plan, which could be someone in HR, maybe any of you that are on this call right now. So some of the duties of the plan administrator, right? And not all of these things are going to be handled by your investment provider, right? Some do distribute annual notices, but typically things like distributing the summary plan descriptions. We'll get into what some of these things mean in a minute, but approving loans and distributions. Again, Nova may review loans and distributions, but someone on your end typically is the one clicking the approve button at the end of the day, and that individual is going to be the 316 administrator, the fiduciary. Okay. But as you can see, there's quite a few things. Getting your contributions in on time. Actually signing the annual 5500 that gets sent in. These are all functions of the plan administrator. So getting into more specific errors that commonly occur. Number one is failure to amend the plan for current law changes. All right, so the IRS every so often will require employers to update their plan documents based on current legislation that Congress passes. And these may take the form of interim amendments between major restatements. So a major restatement, almost all of the plans that any provider uses, including Nova, are template documents, right? So they're fill in the blank. And these template documents come with an IRS opinion letter that says, if you don't go outside the blanks and create your own unique language, you can rely on this letter that you have a qualified plan that's, gets all these tax benefits, and people, don't have to pay taxes on their contributions that go in and so forth. But every so often, approximately every 6 years or so, the IRS approves and releases new template documents, and then everyone is required to update to these new documents. In fact, we just had a new restatement deadline, and new documents were due 7/31 of 2022. You've probably seen a variety of emails from our company, because we do prepare the documents for your signature and get them out. Part of our job is to get them out to you to be signed in a timely fashion. But what we call the tri-cycle restatement was due 7/31 of 2022, most recently. So that just happened. Now, what happens if you miss a required amendment or restatement? Now, this example in 2008 is regarding an interim amendment called the Final 415 regulations. But if you had an attorney or provider, whether it's Nova or an attorney, that sent you the amendment and you failed to adopt it because somehow it got lost, or back in the day, a lot of these amendments were sent out through paper. But if somebody misses an email now, or somehow didn't get the amendment signed on time, now you have to typically file under the IRS voluntary compliance program to get it fixed. So it is fixable, but it's going to cost money under that fee schedule, and then whatever the cost that Nova would have to prepare the filing to submit to the voluntary compliance program. So typically you're looking at least $5,000 right off the bat if you missed a required amendment that needs correction. Another common error is the failure to sign up all of your affiliated employers. So the legal plan documents that NOVA prepares for you have a plan sponsor that's the main sponsor. But if you have related companies that, let's say, companies that you own, well, I'll get into what a related company is, but if you have other companies in your related group and you want them to participate in your plan, they have to adopt the plan using a participation agreement, which is usually a very simple one-page sign-up agreement, if you will, that permits them to participate in your plan. If they're not signed up, they're not eligible to participate in your plan, and quite often we will find out after the fact, we being NOVA, that clients have other companies that they've been permitting to enroll in their plan that we had no idea about, and the legal documents have no indication of. So, in terms of what is a related company, is generally going to be a control group, and that's defined as a company that owns at least 80% of another company. All right. Or there's two types. You've got your parent subsidiary where one entity owns at least 80% of another entity. Or in the case of partnerships and other legal types, if the same 5 or fewer individuals own 80% of more than one company, then you're in this control group, and the IRS views all of the companies, the plan sponsor, and any of these related entities as a single company, and generally wants all of the companies to participate in a single plan. Having multiple plans within a control group is generally a no-no. Again, how do we avoid this error? I mean, NOVA will send out multiple emails and reminders whenever an amendment is required. So, make sure you're reading all the correspondence. Make sure that if you are aware of any additional companies that are part of your related group based on this 80% rule, that they've executed participation agreements to participate in your plan. Again, if they haven't, it can be fixed, but NOVA would need to know about it in order to fix it, right? Also, if company structures change all the time, mergers and acquisitions, you bought another company or your company's been sold, it's very important for us to know about that in advance so that we can properly consult on how to handle the plan in that particular situation. It might involve just signing up the company, but we have an M&A team that can handle that for you, or certainly give you advice and consult with you. And then the other part is, based on all this correspondence, we need to make sure that these amendments and restatements are executed within the deadlines. So these are what are known as operational failures. So failing to follow the provisions of your legal plan document. The IRS requires that you follow the written terms of these legal documents in actual practice, in daily life, right? And if you don't, they reserve the right to disqualify the plan, which would mean that all of the contributions made to the plan would be taxable to the individuals. The company contributions would be, the companies themselves would lose the deductions that they've taken over the course of all the years that the plan's been in existence. So you definitely want to make sure that you're operating the plan in conformity with what the document says. Okay. To that end, there's a compensation definition in the plan document. And sometimes employers will use a different compensation definition in their payroll systems for purposes of calculating what income an employee can make their employee contributions on, what income the employer contributions are calculated on, right? And what happens is if your payroll system is not using the definition that's in your plan document, then legally the participants are receiving incorrect allocations, both on the employee pieces of their contributions and the employer contributions they receive. Now, most of the plans that we draft define compensation as total gross pay paid to an individual on their W-2 each year. not salary. It's the total gross that they earned for the year. All right, excluding bonuses and commissions, overtime is permitted. It may require some special testing on our part, but it has to be in your document. It has to be, if you're excluding bonuses, it has to be a checkbox that says, I'm excluding bonuses in my document. All right, if you're not sure what your definition of compensation is, make sure you call your Nova account manager and they can look in your document and tell you exactly what your payroll system should be doing, or basing the compensation on. So for example, we have a company that adopts a matching formula, and they program their payroll system to calculate a formula based on base pay, which would exclude overtime and bonuses, but the document is based on total gross pay. We've got a mismatch. We've got an operational failure. And what would happen there is that the company is going to have to make up that difference, right, to the individuals. And depending on the magnitude of the problem, we might be able to just self-correct it, or we might have to do a formal filing. But either way, the company owes the contribution difference because of that mismatch. You have to follow your document. So it's always important to review your document and understand, what is my definition of compensation, and make sure that my payroll system matches that. Again, just call us if you need help. And also, whenever you have personnel changeover in your payroll, some companies are handling payroll internally, others, are have outsourced providers. But as you have turnover, make sure that people are trained properly to understand what the provisions of the plan are, and then make sure that they're also running the payroll in conformity with those provisions. Another thing to keep in mind is, it doesn't matter what your offer letters say or what your HR policies are. In terms of these qualified plans, all that matters is what your document says. Okay, so another super common problem is the failure to allow your people entry, or offer your plan to your newly eligible people in a timely manner. Okay, that's definitely one of the functions of the employer, because at Nova, we don't we get your census on an annual basis. We don't know who's being hired and fired during the year. Only you do at the company. And so part of your job is to for your new employees, to make sure that they're offered the plan and participation into your plan according to the terms of the document and on time. All right. So we got a couple of situations where people either don't get offered the plan on time, or sometimes it's the reverse. They're let in early. Okay, I mean that's a problem as well. So, for example, if you had a plan that had no age and service requirement for entry into the plan, and then holds out an individual for 6 months, again, you're going to have to make Steve whole for the employer contribution and for any missed deferrals, and possibly match that he should have received during the time he was improperly held out, plus earnings. So again, there's a cost to it. It's fixable, but you have to fix it, and it's going to cost the company money. So just so everyone understands how initial eligibility in a 401k plan works, there is a maximum waiting period. You can have periods shorter than this, but this is the maximum. So in a 401k plan, the longest you can make somebody wait to initially be eligible is 1 year of service and age 21, with a minimum of 2 entry dates. So the next slide will show you how this works. But any of your plans or any of you that have plans that have a 1 year and age 21 waiting period, should pay very close attention to the next 2 slides, because this is not completely intuitive as to how this works, and you need to know how it does so you can let your people in on time. All right. Typically, the 1 year of service does require a certain number of hours to be accrued during a the service period. It can never be more than 1,000, but typically it's 1,000. And the age requirement can never exceed 21. So you can't put an age requirement in your plan that says I'm going to hold out people that are 25 years old. Okay, I can hold out people that are younger than 21. Now this fourth bullet, again, I'll show you here in a minute how this works. The initial service period or the initial computation period is the 12-month anniversary date from the date of hire, and then it's going to change typically to the calendar year. All right, again, this is like what period of time am I looking at to figure out the 1,000 hours requirement. Let's look at it in a chart. Let's say I hire somebody on 6/1 of 2019. So the computation period for that new hire is, the first computation period is 6/1 of 2020, the 12-month anniversary date from the original date of hire. Not a date of rehire, the original date of hire. You ask the question, did this individual work 1,000 hours in that period? And as you can see, it crosses calendar years, right? But if they did, and in this example, you have semi-annual entry dates, meaning, my entry dates are 1/1 of each year and 7/1 of each year. The person is credited with a year of service on the anniversary date, not in the middle when they get the 1,000 hours, but on 6/1 of 2020, that person now has 1 year of service. And you would offer them the plan on the next entry date, which is 7/1 of 2020. So sometime before 7/1 of 2020, you should give them the enrollment materials and an opportunity to contribute to the plan with a 1 year wait scenario. Okay. Now, let's say that the person did not get 1,000 hours in that period. They only worked 500 hours. So they're not eligible. They have not gotten the 1 year of service on 6/1 of 2020. The computation period, to make it a little easier on everyone, switches to the calendar year. So for the second computation period, you're now measuring the 1,000 hours from 1/1 of 2020 to 12/31 of 2020, right? And asking the same question. Let's say in the second year now, in that second period, they get to the 1,000 hours. They're credited with 1 year of service on 12/31/2020, and you let them in on the 1/1/2021 entry date, or pay periods, immediately after that. Okay. Now, shorter waiting periods are okay, and we have plenty of plans that have those. In any waiting period that's shorter than 1 year of service, generally hours are not counted. It's not based on hours at all. It's based on what we call elapsed time, and there's some service spanning rules that are in effect. Okay. Let's see here. Let me stick on this for a second. So if you've got a 3-month wait, right, it's always again from the original date of hire. But in this situation, you just go to the 3-month anniversary date and you ask the question, is the individual employed on the 3-month anniversary date? If the answer is yes, they get 3 months. The service spanning is just a term for if they were there on the first day, like their original hire date, and they came back right before their 3-month anniversary, they get the whole 3 months. It's not continuous employment in these shorter waiting periods. But they're easier to compute. All you have to think about is, are they there on the 3-month anniversary? Or if you've got a 6-month wait, are they there on the 6-month anniversary? If the answer is yes, they're in. Don't worry about whether they came and went 20 times in between. That doesn't matter at all. Okay? And since hours are not used for this type of shorter waiting period, you're usually not going to exclude your part-time employees, right? There's no hours, even though a part-timer may only work like, 300 hours, let's say, in the period. Doesn't matter, You've got a 3-month wait, you apply it to the part-timers as well. So this leads into improperly excluding certain classes of employees, like part-timers, for example, right? So if a plan sponsor or plan is excluding hourly employees from their 401k plan, that might be okay, but your plan document needs to be written with that class exclusion in it, like we exclude hourly employees, right? Um, Now, certain exclusions are subject to some additional testing, which I won't bore you with, but again, the whole concept is your document has to be in line with what you're doing. And when you're out of line, that's when we've got a problem to fix. All right. This is a very common error. Again, a lot of plan sponsors think, I'll exclude part-time and seasonal people because I know, again, right, for HR purposes, part-time is generally not eligible for your health and welfare benefits. Completely different set of rules for 401k. You know, though they're not the same. So the IRS does not like part-time or seasonal exclusion language in their documents. The reason for that is they view that as a way to circumvent the maximum waiting period of 1 year, right? I can say in my document, I'm excluding part-time people. Well, you can have part-timers that work 1,000 hours, right? And you're perpetually excluding them, which violates the 1 year rule. They don't like that. So agent exclusion language in your document that uses service-based definitions like part-time, seasonal, temporary. They don't like that exclusion, and it's very difficult to manage. So if you're doing that and excluding those types of people, we need to review your document and probably take a look and see if you're doing it right. So also, just to show you how much the IRS dislikes this rule, they've got new regulations regarding long-term part-time employees. Okay. Let me stay on this one for a minute. So a long-term part-time employee is generally someone, so you've got somebody that's continuously part-time and works at least 500 hours each year. The IRS is going to have some new regulations that are effective shortly that are going to require you to offer even your part-time, no matter what your document says about part-time exclusions, they're going to require you to include these individuals or offer them the plan for at least the employee contribution portion. You may not have to give them an employer contribution, but they're going to make you include them in your plan, or at least offer the plan to them, no matter what your document says. So this is an entire webinar on its own, and I think we have some webinars coming up on this subject here shortly. So keep an eye out. But
Steve, we had
again,
a question come in.
yeah.
If you have 6-month eligibility with 1,000 hours, what would be the next eligibility computation period after the first 6 months?
Well, that's what I'm saying. There's no such thing as 6 months and 1,000 hours. Not permitted. Hopefully your plan document doesn't say that, but if it does, send me an email afterwards. My contact information will be there, and we'll review your plan document with you. Shorter waiting periods are based on elapsed time, not hours. It's like go from the original date of hire. Are they there on your 6-month anniversary date or your 3-month anniversary date, whatever your document waiting period is? If they get there, if the answer is yes, they're in right then. So there's no counting hours on these short eligibility periods. All right. So again, on this, which class of employee do I include and who do I exclude? Be aware of, your eligibility and entry date requirements in your plan. Like, what is your waiting period? Are you 3 months, 6 months? Is it a 1 year? Don't generally your plans are not written to exclude classes of employees like part-timers or field workers. I'm not saying there aren't any plans like that, but again, your document rules, not anything else in HR. All right. Also, it's good practice, just to show, if the IRS ever comes to audit you, one of the things they definitely look for is, have you been offering your plan to the right group of people on time? Now, how do you prove that? Well, I would collect not only, when you give people enrollment materials, not only should you keep the people that elect to participate, but require your people that are declining to fill in a form that says 0, right? Or another way you could do it is, if you're sending emails out to send out enrollment materials or however it's handled, there's a variety of ways. Keep records of these emails that are sent to people that, hey, I offered I sent the forms to, Joe Smith on this date, right? And keep those in your records because they're going to want to see that. Another question that comes up a lot and deals, can result in errors is, dealing with rehires. What do we do with rehires? Because that does happen a lot. If you ever have, the general rule is if you ever have a formally eligible employee who ever had a single vested dollar in your plan of any kind, it could be the employee or the employer money, then they generally never lose their prior service credits. Okay? So I could have somebody that was hired, 5 years ago, and they had money in the plan, and they were there for 5 years prior to that. So they had 5 years of service, were gone for 5 years, then they come back. They have 5 years of service. They don't have to requalify to get in your plan. You should offer them the plan immediately upon rehire. They don't have to wait for the entry date, the 3-month wait, or whatever your plan has. None of that. Offer them the plan immediately. Okay? Now, if you happen to have somebody that was previously eligible and never had any money in the plan because they just chose not to ever contribute, they would lose their prior service credits after they've been gone 5 consecutive years. That's pretty rare, because rehiring people that have been gone for 5 years is probably rare enough. And then the fact that they were eligible and never had money in the plan, just think about rehires generally, you're going to want to offer them the plan immediately. Again, if they previously met the 3-month or the 1-year wait. Okay? They don't have to have contributed necessarily, right? So. All right, so vesting, that's service crediting for vesting versus initial eligibility. We've talked about how does a 1-year wait work? How does a 3-month wait work? How does vesting work? Because now there's a different, this is more informational for you because, NOVA, as well as your record keepers, your investment providers, we do track this for you. But just so you know how it works, by law, initial eligibility has to be credited from the original date of hire, as we've been talking about. For vesting, it's always computed on a plan year basis. All right. So, for example, let me go back to this. So, if you have 1,000 hours for purposes of accruing a year of service for vesting, we're going to look just at the calendar year. That's why every census we send you each year asks for the number of hours that your individuals worked. That's used partially to compute initial eligibility for our testing, but it also is used for vesting purposes. So vesting is, you have to get to 1,000 hours in a plan year, which is generally the calendar year. There are also additional requirements you can place on who receives your employer contribution allocations. So think about somebody that is eligible to contribute to the plan on an employee contribution basis, right? But you can put some additional restrictions on whether they get the match, or if you're doing a profit sharing allocation, you can have some additional requirements for them to receive your employer contributions. So don't confuse that with initial eligibility. They're otherwise eligible, but you can exclude, for example, people that are not employed on the last day of the plan year from, let's say, getting your match or your profit sharing. You might even be able to require 1,000 that they worked at least 1,000 hours in that particular plan year to get the employer piece. Generally, you're not going to see any of those types of requirements. If you're doing payroll by payroll, just don't worry about this at all. But for plans that fund their employer contributions annually, we can add extra requirements. Let me see how we're doing on time. Okay, good. All right, so loans are very popular in 401k plans, and they are subject to a variety of rules. We do see some errors with loans. we'll go into the details of what some of the rules are, but there can be failures that are related to exceeding what the maximum dollar amount for a loan is. You can have loan repayment schedules that don't meet the timing or the payment limits by the according to the IRS code. Um, and then probably one of the more common ones is not starting your loan repayments in payroll on time when somebody takes a loan. All right, so if there's an error with a loan, like you didn't start your repayments on time, there is a cure period during which you can fix it or bring it up to speed, right? So delinquent loans, or loans where payments have been missed, have to be corrected no later than the quarter following the quarter in which the first payment is missed. All right. If they're not fixed within this time frame, so depending on when a payment is missed, you could have up to 6 months or something less. But if you don't fix it within that time frame, the loan has to be defaulted according to IRS regulation, which means that the individual is going to get a 1099-R reporting the loan as being taxable income to that participant. And then they may be, if they're under age 59 and a half, they'll also be subject to an early withdrawal penalty of 10%, right? But basically, the loan becomes taxable because loans, an individual is not borrowing money from anyone else. They are taking money from their own account, loaning it to themselves, and then repaying it. And but at the time that they receive the cash out of the plan, it's not considered taxable on that event. But again, if you don't follow the rules for loans, it can become taxable if you're in default, right? So a lot of investment providers, again, the Voyas and the Mass Mutuals of the world. I know I'm leaving out a lot, but we've got about 10 or 15 of them. We'll give you reports on which loans are delinquent. Every provider is a little bit different, but and many of the providers will need to be told to default a loan. So others do it automatically. It just depends on who you're with. All right. So there's a few ways to fix it. How do I fix a loan that's gone into default? You can either catch up the missed loan repayments. The individual can completely pay off the loan. If they owed like $4,000, they can just cut a check for $4,000. That gets sent into the plan and the loan is paid off. Or the more common one is, the loan needs to be reamortized or refinanced. So you've missed like a month's worth of payment. Nova and or your investment company would have to create a new amortization schedule so that the payment will go up a little bit and the loan would be paid off by the maturity date. Okay. Again, after the cure period ends, the loans can be corrected. This has actually changed. I need to update this. The nice thing now is that even if you're after the cure period, so long as you're not longer than the maximum loan period. So one of the rules for loans is you can't take a loan for more than 5 years unless it's to purchase your principal residence. So most loans, the maximum payoff period is 5 years. So long as you're within the 5-year period, even if you miss your 6-month cure period, right, you can still refinance the loan now without having to file under the IRS compliance program. Which is very nice. It used to be to fix a loan that was older than 6 months out of compliance. You had to do a formal filing, which, as we saw, you're not going to go fix one loan for $3,000 for the filing fee, right? Like most people wouldn't do that. So now this is good for not having to default as many loans and cause hardship on your participant. But if it's older than 5 years, then you're out of luck. You're still going to have to default the loan. So some examples, probably the most common one, you have a company participant that takes out a loan, but the payroll person or the plan administrator fails to set up the loan payments in payroll. And then the participant doesn't notice it either and makes no arrangement to make payment. Several months go by and the plan administrator realizes these payments are not being deducted. Generally, the loan has to be considered in default, and it would be a taxable distribution to that participant. As I said before, if you notice those things, we can refinance them as well. Um, so some of the rules for loans involve the maximum loan amount. So loans, no matter how much money you have in your account, you can have $1 million balance. The maximum loan is $50,000. It's usually 50% of whatever the person's vested account balance is, up to a maximum of 50,000. So in this example, if somebody somehow was able to get a loan for 60,000, then that excess amount. We've got a typo here. It says well, actually, no, it's not. The loan amount in excess of 50,000, so 10,000 in this case, would be considered a taxable distribution. And there's no fix on that one. I mean, if you took more than the maximum limit, that excess amount is now going to be taxable and subject to penalties. Penalties paid by the individual in this case. So just make sure, again, like all of your investment providers have some method usually of indicating what loans are outstanding. Many have loan delinquency reports, or they'll tell you, loan payments have not been made on this particular loan in 2 months or whatever, right? So keep an eye out on those reports. Some you have to download, some are sent out automatically. And make sure that the individuals that have loans are still actively employed and payments are going in for those people. Like you match up who has a loan at, Voya and who you show is having loan repayments coming out of their checks in your payroll system, and make sure they're lining up. If the person is terminated, obviously they're not going to have loan repayments out, but you want to make sure they're terminated. And for the individuals that are terminated, they should be defaulted within a certain amount of time. Like I said, the default is not automatic, but as an administrator, it's up to you to sort of monitor who's terminated and may need a loan default. So Nova does help some with that, but we only usually have an annual review of some of the delinquency reports, and those just depend on the vendor too. So we don't do it necessarily for everyone, but I know like those of you with John Hancock, for example, we do have an annual process which looks at the loan delinquency reports, and our distribution team tries to determine which loans might need to be defaulted to help you out. But at the end of the day, we're doing that as just a value-added service, and it's really your responsibility for figuring out which loans need to be defaulted. Okay. Timely deposits of employee contributions is a big Department of Labor audit item. In fact, if you ever get audited by the Department of Labor, they're looking almost exclusively at this. Okay. So from the payroll date that a deduction is taken, how long do I have basically to send that money into your investment provider, into the individual's 401k account? All right. If you're a small plan or a large plan, the rules are a little bit different. So a small plan has a 7 business day requirement. You have 7 business days from the pay date to send the contributions in. And this involves the employee contributions. All right, your employer contributions could be sent in at a later date, but at the very least, the employee amounts, whether they're loan repayments or the employee contributions themselves, have to be sent in within 7 business days. All right. This last bullet that indicates a safe harbor, basically, this is not safe harbor as in a safe harbor plan. This is just the safe harbor rule for sending in your contributions timely. Basically, if you miss one pay period, like just one pay period was on the 8th business day or the 9th business day, the Department of Labor could theoretically come in and say, you lose the 7 business day standard, and now we're reverting you to the large plan standard, which is as soon as administratively possible. So large plans have to send in those same employee contributions as soon as administratively possible. It says, but not later than the 15th day of the month following. You can forget about the second bullet altogether. It's the first one that applies. What does that mean, as soon as administratively possible? Well, upon audit, the The DOL will look at your other business practices. If you're sending in, for example, your federal withholding within 3 days, they're going to ask, well, why are you holding on to the employee contributions for a week or 10 days, right? Um, you know, so they're going to look at your other administrative procedures and determine what your standard is. Everybody could have a slightly different one, but in general, I would say if you're sending them in and you're a large plan, stick to 3 to 5 business days maximum. Maximum. Um, that's what the DOL would do right there. So again, if they come out at you, they're almost exclusively looking for that. And also, if you're a large plan, you're subject to an independent CPA audit on your plan. Those, if we have any large plans on the call right now, you know about this. You have to go hire a audit firm to issue an audit report, which is then filed with your 5500. That CPA firm looks for late contributions as part of their audit checklist, and so that's a huge issue for them as well. So again, just a little example. If we have a company that fails to deposit employee contributions for a pay period until 3 months after the deduction date, what do we do? Well, it is again fixable. It's a fixable issue, but the company has to pay each participant lost investment earnings, and the Department of Labor has a methodology on how you compute that, or we would compute that for you. Um, but they also are considered prohibited transactions, and you have to pay an excise tax. So it's earnings plus a possible excise tax um, that needs to be paid on any late contributions. So again, just make sure you've determined what applicable deadline applies to your plan. Is it the small deadline, small plan deadline, or the large plan? Make sure you're setting up procedures to ensure the deposits are made, by the deadline that applies for your type of plan. And whenever the do I have a procedure for a backup if my regular payroll person or whoever submits these contributions to your investment providers is out? How am I going to handle that, right? If you've got multiple payrolls, make sure you're checking that they're all doing it the same way. We have clients that have multiple companies, each running their own payroll. Everybody's got to be on the same page, if you've got multiple companies. The other thing is be consistent. If you're going to say, we're sending them in 3 days, you really should try to be consistent. Just do it on 3 days. If you start doing some on 1 day and some on 5 days and you're all over the place, the DOL can come in and say, you got these 4 in on 1 day, the first day right after the pay period. Your standard's 1 day. I haven't seen them do that really, but I mean, they could. So just stick to one standard and be consistent. There's also a legal requirement to separately account for all the different contribution types. So again, like imagine your account at John Hancock. Each individual is going to have a separate line item, one for their employee contributions. There might be a separate one for the Roth employee contributions, a separate one for the match, profit sharing. All of these different money types have to be sent into the right bucket with Hancock, Voya, whoever, right? Why? Employee contributions are 100% vested immediately. Your regular match might be, subject to a vesting schedule. Safe harbor and non-elective employer contributions are also 100% vested. So distribution rules and vesting are all different for these different money types. And if you get them commingled in the wrong one, again, you've got a big problem because people are going to get paid out wrong, right? So I basically described it, but let's say you amend your plan to go from a regular discretionary matching source that's subject to vesting, and you convert to a safe harbor matching formula from 1 year to the next, right? And you just continue to send in your safe harbor contributions to the regular matching source that's subject to vesting. Again, everybody's going to be paid out wrong. We've got a kind of a complicated correction to get that fixed, to get all the money in the right source. And if no one notices it soon enough, then people are going to get paid out wrong. And you as the company could potentially have to make up the losses or the differences in the mistake. So again, you're the ones typically making the deposits. Payroll happens, you send in the contributions. That's one of your responsibilities, and they need to go into the right bucket. Each of your providers has some sort of little template where you're uploading. Here are the employee contributions. Here are the employer contributions, and column A, B, C, D, right? And then you send that to them, and they draft your bank account. If you get those columns jumbled up and they go in the wrong sources, there's going to be a problem, right? Failure to properly limit contributions. I think everyone's fairly aware of the employee contribution limit for 2022. Again, this is the maximum amount that any one individual can contribute employee money on, and that limit is $20,500. And anybody that's over the age of 50 this year can put in an additional $6,500. All right, so just make sure that your payroll system is set up to limit people properly. We do check for this at the end of the year, but it's just better if the mistake doesn't happen right off the bat, if the payroll system's set up right. So you don't have to have separate fields in your payroll system for the 20,500 or the 6,500 in separate fields. Just think about it as two different limits. If I'm under 50, my limit is 20,500. If the individual is over 50 or 50 or older, it's 27,000. Very simple. Matching contributions, there are a lot of mistakes on this one. Matching contributions need to be limited as well, and it's because in a 401k plan, each year there's a maximum compensation dollar limit that we have to count contributions on. So we cannot, if somebody makes 500,000, the limit is still 305,000. So again, this is for 2022. Sometimes these limits are indexed, but what happens here in this example, because of this compensation cap that's just required by law, it'll limit your matching contribution based on what formula you use. So let's say you have a plan that has a 50% on the first 6% formula. Then the maximum any one person should ever get is $9,150 this year. And the way we arrive at that is you take the $305,000 limit in place this year times 6% times 50%, right? And that's how we come up. And if you give someone too much match, the excess really needs to be forfeited along with any earnings or losses. And if you don't notice it in time, somebody you could give somebody, let's say, $15,000 because they made $800,000, and if you don't catch it on time, they could terminate and take all the money, like you over contributed to them, and if no one notices, they'll take it all if they happen to just terminate and take the money before we can fix the problem. For safe harbor plans, I'm sure we've got a lot of those on the phone right now. Your formula, if it's a basic safe harbor match, is 100% on the first 3%, plus an additional 50% on the next 2%, which means that your formula caps out at 4%. So the maximum any one person should ever get matched is $12,200 for this year. Again, you just take, there's a typo here, it's 305,000 times 4%. So sorry about the typo there, but it is 305,000. So make sure that your payroll system is set up to cap out these employer matching contributions so that you're not over contributing to someone. All right. So I'm going to speed along because we're running out of time here. I think we talked about how do you try to avoid this problem. Failure to properly distribute employee notices. There's a variety of annual notices, some of which you're responsible for, and some of which your investment providers may handle for you. But this just to make you aware. If you have forfeitures, like for vesting, if your employer contribution, if somebody leaves and they're not fully vested, those non-vested funds get transferred to a forfeiture account, which is just a holding account at your investment provider, and then you can use that money for certain purposes. So under our plan document, it's okay to reduce your ongoing employer contributions, right? If you're making them payroll by payroll, or even annually, you can reduce your annual obligation so that, you know, if you had a $100,000 contribution due and you got $10,000 in your forfeiture account, you can let your investment provider know that take $10,000 out of the forfeiture account and then just draft my bank account for the 90, right? So you're using up the funds. The one thing you never want to have happen though is you never want a check going back to you as an employer. That's a prohibited transaction. Okay. You can also use the forfeitures to pay, you know, your routine plan expenses. Now, again, we've gone over a lot of information. You know, what do you? God, I'd be like overwhelmed at this point, thinking I've got so many things to do. Like, what can I do? I'm not an expert in retirement plans. You can actually retain a 316 administrative fiduciary firm, right? So you're hiring an expert in the field. It's like, think about like fractional HR. You know, you don't have a big HR department, so you're hiring somebody else outside to handle most of your HR, right? You can do the same thing with a 401k plan. Save your internal staff time and money, you know, and then obviously they're experts, so you know, you're going to reduce your liability if a mistake happens for something they're responsible for that causes the need for contributions to be made to the plan. They're going to fund the contribution, not your company, right? And hopefully they're just going to eliminate the error altogether. But if there is one, you know, you're able to reduce your liability. I'm not going to go through all of this, but now again, Nova is not a fiduciary. We are actually just operating on a ministerial basis, meaning we prep everything, kind of like a CPA would. So we're preparing a 5500, we're preparing your testing, but we don't approve loans and distributions. We don't sign the 5500. You know, so we're not a fiduciary. You know, the administrators in your companies, you're the fiduciaries. So if you hired a company like a 316 administrator, they would be a fiduciary, meaning mistakes, they're going to cut the check. So if you need help, I'm going to skip over all this because we're out of time. There's a variety of levels of service. You know, the owners of Nova create a separate company, and it's separate because they are a fiduciary, but it's called Administrative Fiduciary Services, Inc. They can take over a lot of what you're responsible for. In fact, the majority. It's not like you're ever not going to be a fiduciary completely, but for the functions they take over, and you know, you can review these in the slide deck that we have. But there's a variety of things that they would do that you're responsible for on a fiduciary basis. So if you need help, you know, call this individual, Araceli Valdez, or myself. I'm a shareholder there as well. And let us know if we can help you in any way. There is more additional fees involved, but compared to the cost of hiring, you know, additional staff, if you need help, you know, a company like this could really help you out. So if you feel like you're overwhelmed and need help, just call us. Do we have any questions that we can just knock through here?
We do not have any questions.
Okay. All right. Well, if anybody thinks of any, here's my contact information. Feel free to shoot me an email and be happy to help you out and answer any questions you have. And thank you for being here and being Nova clients. We appreciate your business, and thanks for taking some time out of your day to listen to this webinar.
Perfect. And just a reminder to fill out the survey at the end of this webinar so that we can track who will be needing a certificate. If you have any questions, go ahead and email Steve, or you can email us at webinars@nova401k.com, and we can make sure to get that to him. Also, on the handouts portion, you will find the presentation for today and also a brochure for AFS if you guys are interested. To view any webinars you may have missed in the recording of this session, you can follow us on our YouTube channel, which is Nova 401k Associates, or you can visit our website, which is www.nova401k.com/webinars. Thank you, Steve, for your time today, and thanks again, everyone, for joining. We hope you enjoy the rest of your day.